All right, in the consumer discretionary space, something really weird is happening. An absolute anomaly, and it really demands a closer look. What we're seeing with Under Armour stock is just incredible, especially when you look at how it's completely bucking the trend for the entire sector.
I mean, look at this. This isn't just a small blip or a normal market trend. It's what we call a massive structural divergence. You see that orange line just soaring? That's Under Armour. It's completely decoupling from its peers. So the real question here is, what on earth is driving this technical breakout?
And yeah, the numbers really drive this home. Under Armour is up a staggering 30% year to date. But just look at the world around it. The giants, they're getting hammered. Nike's down 8%, and Lululemon, which was everyone's favorite darling, is down almost 17%. It's a total bloodbath out there, except for UAA.
So what's going on? The main driver here is what we'd call an idiosyncratic valuation reset. Okay, that's a mouthful. But in simple terms, it just means Under Armour stock is moving because of things happening inside the company. Unique catalysts that have absolutely nothing to do with the general health of the apparel market. And that catalyst? It was huge. I mean, the market was basically braced for a total disaster heading into their February 6th earnings call. Analysts were expecting a loss, forecasting minus 2 cents a share. But what happened? Under Armour came out and delivered a 9-cent profit. Not only that, they raised their guidance for the whole year. They didn't just beat expectations, they completely shattered them. And this is where the story gets really, really interesting from a market dynamics perspective. That earnings beat, it didn't just make the long-term investors happy. No, it lit the fuse on a tinderbox of market positioning that was just waiting to explode. This is where the mechanics of the market totally took over. And when I say tinderbox, I mean it. Check this out. Heading into that report, almost 24% of Under Armour's publicly available shares were sold short. Just let that sink in. It was the single most shorted consumer stock in the entire S&P 500. The market wasn't just skeptical, it was making a massive bet that this company was going to fail. So you can imagine what happened next, right? They dropped that surprise profit, and then to top it all off, a major insider, Prem Watsa, comes in and buys over 13 million shares. Bam! That triggered a violent short squeeze. All those people betting against the stock, they had to scramble to buy back shares just to cover their massive losses. And what does that do? It's like pouring gasoline on a fire, sending the stock absolutely rocketing higher. I mean, it was just the perfect storm, technically speaking. You had the fundamental surprise from the earnings beat. You had the forward-looking confidence of them raising their guidance. And then you had that powerful, powerful signal of a huge insider purchase. It was a 1-2-3 punch that basically forced all the short sellers to just give up and run for the exits. Okay, but we really have to slow down and emphasize what the real narrative is here, because this is where the story shifts from just pure market mechanics back to the business fundamentals. And this isn't a simple case of a company suddenly selling a ton more shoes and shirts. The driver underneath all this, it's different, and frankly, it's a lot more complicated. So we keep coming back to this incredible number, right? This 30% gain year to date. But here's the paradox, the thing every investor really needs to wrap their head around. How in the world does a stock do this when the core business is actually shrinking? And this is exactly where my skepticism kicks in. This chart just perfectly illustrates the huge disconnect. While the stock is soaring, their actual revenue fell 5% overall. And even worse, it was down a massive 10% in their most important market, North America. So let's be clear, they are selling less stuff, not more. Right, so the main takeaway, the crucial point is this. The market is not rewarding Under Armour for growth. It's not about selling more products. Investors are rewarding them for aggressive cost-cutting and for repairing their margins. They're basically celebrating the company becoming more profitable on lower sales, which, is a very, very different kind of turnaround story. And remember, all of this is happening in the context of a broader sector rotation. What we're seeing is investors pulling money out of those expensive, high-multiple mature giants and looking for deeply discounted value plays, like UAA, where the bar for success was, let's be honest, set incredibly low. Yeah, this slide really puts it all into perspective. You see UAA benefiting from being seen as this cheap value play. Meanwhile, the premium brands are getting squeezed. Lululemon, which was the pandemic darling, is now facing a consumer who's thinking twice about high-priced leggings. And Nike is wrestling with a major slowdown in China. It's tough at the top. And that's because there's this huge macro overhang affecting the entire sector. Consumers everywhere are becoming more value conscious. The constant threat of tariffs and supply chain chaos is eating into margins. And key growth markets, especially China, are really hitting a wall. The big players, they just don't have anywhere to hide from this stuff. Which, of course, brings us to the most important question of all. The short squeeze seems to be over. The technical fireworks have died down. So now what? Can Under Armour actually hold on to these massive gains? What does the road ahead really look like now that it's all about the fundamentals? And there are definitely some significant risks here. For one, the market is eventually going to demand to see some sales growth. You just can't cut your way to prosperity forever. The company also has a shaky history with C-suite turnover, and it's still way too dependent on that struggling North American consumer. The technical rocket fuel is all used up. Now the fundamentals have to do all the heavy lifting. So we'll leave you with this question to think about. Was this whole thing just a fleeting technical event that was all about a massive short squeeze? Or is this the real beginning of a true sustainable turnaround and profitability for Under Armour? The next few quarters, well, they're going to tell the real story.